I mean, given all of the data that's out there, both in the U.S. and the world, the moves we've seen in markets more broadly, what is your sense about these risks of a potential recession?
Well, it certainly has gone up over the last few days, but it's a complicated tussle, right? We have three games of chicken going on simultaneously. One, of course, between the U.S. administration and the Chinese administration over trade. We also have one between the U.S. administration and the Federal Reserve over Federal Reserve policy. And finally, we have one between the Federal Reserve and the markets about who is going to blink first. So a lot depends on how these play out, because to some extent they are affecting the real economy around the world. They're affecting investor sentiment. They're affecting business sentiment. So far, they haven't had a big effect on consumer sentiment, but that could happen.
In terms of the yield curve, the flattening of the yield curve that we've seen, that brief inversion between 2 and 10 spread here in the U.S. and also, by the way, in the U.K. earlier this week, what does that signal to you?
Well, it's more complicated now because there are forces which are operating on the yield curve which didn't operate in the past. Typically, what used to happen is inversion used to happen when inflation was really high, and there was a feeling to some extent that short-term policy rates needed to be really high to bring down long-term interest rates over time. And so you had a yield curve inverting when there was a feeling that policy rates would tighten. This time it's more about the fact that the long term may look pretty bad, that interest rates will have to remain low, and to some extent bonds are a hedge in this kind of environment. And some of the flattening of the yield curve is because that's embedding a premium for bonds at this time. So we have to be a little careful, but it does suggest things are a little worse than they were in the past. It doesn't, I think, it's not a surefire signal of recession.
How attuned are you to a change in high yield spreads, which is often, especially this week, a reason for people who doubt a recession to say one's not coming?
Well, I think high yield spreads, again, some of it is influenced by which sectors are part of that high yield. For example, the shale sector has issued a lot of high yield bonds. And of course, with the oil price falling, some of that extraction is not remunerative. So I think it really depends on what's going into that high yield spread. But I would say at this point, the strength of the economy comes from a still strong consumer who's still being held up by strong labor numbers. That could change, but it hasn't changed so far. It is an economy which still seems to be progressing reasonably despite everything that's been thrown against it.
Yeah. Sir, how quickly can we reverse some of the damage that's been done because of the trade war and the tariffs, assuming we do get a deal? I presume that this can't be changed overnight.
Yeah, no, I think some of the sentiment will reverse if we get a quick deal. But a quick deal will not alleviate the longer-term concern that some of the same issues that are the basis of conflict, intellectual property theft, the restrictions on companies investing across borders, those will come back to the table because it's hard to see a comprehensive deal with the kind of monitoring structure which makes both the United States and China feel comfortable. So my sense is anything short-term is going to be a cosmetic deal. We'll take off tariffs in exchange for you buying more of our stuff, but that will not satisfy. The other problem is the longer the conflict between the two countries goes on, the harder it is to do a cosmetic deal because people are not going to be satisfied. You fought so long just for this. And so it's getting more complicated as this drags on. But of course, both the United States and China have an incentive to deal because both economies are being hurt by this impasse.
Yeah, and really to that last point, Raghu, if we do start to see some of these, and we've seen the softer data, Germany GDP this week, for example, some of the numbers coming out of China, if you do see certain regions or certain markets of the world, Europe, Asia, actually tip over into recession, can the U.S. avoid that, and for how long?
The U.S. is more resilient than many of these economies because it's much more self-contained. But no, we are not an island independent of the rest of the world. And it will affect, if nothing else, through the sentiment channel. If the rest of the world is going down, how long can the U.S. continue chugging along? So I do believe that we are, in the United States, more resilient, but we're not totally immune to what happens outside. I do think the forces from outside will put pressure on both the administration and the Federal Reserve to think about policy going forward.